Hello and welcome, everyone. The Wall Street Blockchain Alliance is very proud to offer our latest webinar, Understanding IRS Revenue Procedure 2024-28 and its impact on digital assets. Before we begin, a bit of housekeeping for today's session. Please keep in mind that this event is offered for general information and educational purposes only and is not intended to constitute investment, legal, tax, or accounting advice. And obviously, the views or opinions expressed are those of the participants and do not necessarily reflect the views of the Wall Street Blockchain Alliance or our participants' firms. This webinar is being recorded. All attendees will be in listen-only mode. Attendees, you're definitely encouraged to submit questions for our amazing panelists using the Zoom Q&A function, and we will reserve time at the end of the webinar for audience Q&A. And with that, we will turn it over to our host and moderator, Dr. Sean Stein-Smith.
Thank you, Ron. Morning, good afternoon, good evening to everyone tuning into this live or watching it after the fact. So to introduce our panelists today, I'm going to ask each of our panelists to do a quick introduction of themselves and their firm and their current sort of focus at the firm. So I'll go in the order: Robert, Jesselyn, Nick, and Pat. Robert, want to go first?
Thanks. Good day, good evening, good afternoon. I'm Robert Toby. I have CPA license. I'm the managing member of Robert L. Toby and Company CPA LLC, located in Sleepy Hollow, New York. I have a specialty tax practice dealing with high net worth individuals, complex operating business, both locally and both in U.S. and internationally. I also do a lot of work in the crypto asset space. I'm a member of the Wall Street Blockchain Alliance Accounting Working Group. I serve in the AICPA's Digital Asset Task Force. I speak on a good portion of this. I work with a number of crypto investment partnerships and having to deal with their issues. And I do very complex IRS representation. So I don't know if my information is in here. You can reach me at 434-882-2211. I return phone calls, or I guess I'll pop my email address in this thing too. I think I can do it with my name. So thanks, Sean.
All right, Robert, thank you.
Hi, everyone. I'm Jesselyn Dean. I'm the Vice President of Tax Information Reporting with Legible. Legible is a software company that supports cost basis reporting for digital assets, not just crypto. And in my role, I am the technical subject matter expert on all things 1099 reporting and cost basis. And our founder would hate me if I didn't mention I was one of, I think it was 12 people who testified in front of the Internal Revenue Service regarding the broker regulations, the 1099 DA broker regulations. So all of my expertise is going to come from the perspective of the brokers that hand out 1099s. Back to you.
Hi, everybody. Nick Farr. I'm a director with Forvis Mazars. I also lead our blockchain and digital asset practice. I sit on the accounting working group for Wall Street Blockchain Alliance and also sit and help out with the AICPA Digital Asset Tax Task Force. I'm excited to be here and speak with you all today.
Hey, everybody. My name is Pat White. I'm the CEO and co-founder of Bitwave. Bitwave is the leading digital asset finance platform. This is a platform designed for businesses using digital assets within their enterprise to help with accounting, tax, financial operations, payments, and now institutional reconciliation. So we're here to talk. I'm super excited today to talk a little about the very practical implications of everything here that the big brains around me get to talk about the theory on. So it should be fun.
Excellent stuff, excellent stuff. And to really sort of get our panel underway, and I'll toss this out to the whole panel, what are we actually talking about here, right? Rev Proc 2428, what is it? How do we get here? And then how is this different, or how is this changing versus the current tax and other reporting obligations out there? Toss it out to the panel.
Yeah, I'll go ahead and start, and you guys can jump in here and fill in the holes of what I missed. But so essentially, I'm going to go back to the very beginning. In November of 2021, the Congress passed the Infrastructure Investment and Jobs Act, and in order to fund that bill, the IRS is going to be required to issue the IRS is going to require brokers to issue 1099s related to digital asset activity beginning on January 1st of 2025. So about a month and a half away. Those transactions are going to, within a limited scope, going to be reported on a 1099. Well, within those final regs that we received related to that 1099 reporting for digital asset activity, the IRS also issued this Revenue Procedure 2024-28. And basically within those final regs, the IRS said, listen, we understand that taxpayers previously have been using what's called the universal method to go through and calculate their cost basis and to determine their tax gain or loss that eventually flows through to their tax return. And they also said, we understand that that's happening, but we don't agree with that method. And beginning on 1/1 of 2025, we want taxpayers to transition to what's called a wallet by wallet or account by account method. But you know, in my opinion, the IRS is being nice in this scenario, and they're saying, listen, in order to basically transfer from this universal method to a wallet by wallet method, we're going to give you a one-time snapshot, safe harbor. If you comply with these certain rules, then basically you're protected from us if we ever audit your tax return, us going back and recalculating your cost basis in previous years that you did use the universal method. So kind of this one-time way to transition to this new method, and almost the IRS is going to basically turn a blind eye to what happened previously. But you have to meet the safe harbor. Well, in order to meet the safe harbor, there's two ways that you can do it. There's a global allocation method, and then there's a specific allocation method. And generally speaking, the due date to comply with both of these is the end of the year, the end of this calendar year, 12/31/2024. Now, there are some exceptions to that, and it could extend beyond 12/31 of 2024, depending on your facts and circumstances. But I would say just, for kind of like an 80-20 rule, let's focus on the 12/31/24 being the due date to comply with this. So for the global allocation method, what you need to do is basically document in your books and records what your global allocation method is. And I'm sure we'll get into what that looks like, so I won't dive into it too deep right now, but you need to document that in your records before 12/31/24, and then effectively go through and perform the arithmetic before you file your tax return for the year that includes 1/1 of 2025. The second method, the specific allocation method, that's a little bit more nuanced, and that's where I'm oversimplifying here, but taxpayers can essentially go in and cherry pick which lots that they want and allocate them to their specific wallets that they own. So it's not like a spread the peanut butter type of method like the global allocation method is. It's more of a cherry pick and specifically allocate each lot to specific wallets. So that's a real high level understanding of what we're talking about here. I know I just rambled on for quite a bit. Panel, what did I miss?
So
sorry, Pat. So I'm going to stick with the technical stuff for a couple minutes, Pat. Then we'll get to the nuts and the bolts. So this doesn't apply to all taxpayers. This applies to people who own crypto assets as investors. There's different types of people. There are investors and there's people who trade crypto assets. This does not apply to folks who are traders of crypto assets. There also to give you another reference point, and I believe this is online, there are some current concerns that the AICPA's Digital Asset Task Force has with respect to this and how this is going to be applied. There's a comment letter I think you can get to online that outlines our concerns, and Nick was instrumental in drawing this up. It's yes, there's a safe harbor. What happens if you don't meet the safe harbor? The IRS says if you don't meet the safe harbor and don't follow these rules, there's the potential for penalties and interest and additional tax. We don't know about this. Other questions have come up is what happens if there's an exam or if you file an amended return once you make an election and it's an irrevocable election to use the safe harbor method. Once you do that, how do you go back and change your calculation if you have to do it? Unclear. There is a lot of unclarity with respect to this and how it applies. We have asked the IRS to go out and issue to first of all, a lot of taxpayers, we may be telling you this information for the first time. You may be hearing it for the first time. I will tell you, a lot of my clients have not heard about this for a lot at all, and they are crypto investors that have crypto funds. There's other practical issues that go into this. Does the broker, once you allocate this going into 2026, when a broker has to report your basis, does the broker have to follow what you calculate your basis is? If you submit them to, do they have to accept it? It's unclear if they have to accept it. I believe the law says, Nick, correct me if I'm wrong, they may accept it. So yeah, you could come up with some still non-reconciling answers between what you come up and with what the broker comes up with. This is more, the onus on this Rev Proc is not on brokers, it's on taxpayers. It's the taxpayers who have to comply with this. And you need to take the steps now to comply with it, because the date is December 31st, 2024, January 1st, 2025. We can talk about minutes here at the end of the year, but you're supposed to have the allocation method decided upon, the allocation done, and have it memorialized by January 1st to be effective for trades of cryptocurrency held before December 31st. The safe harbor doesn't apply to assets that are acquired after January 1st, 2025. Is there anything else I missed, guys? Any other elucidation?
I'll mention something really quickly. Oh, sorry, Sean.
What I just wanted to clarify something that you had mentioned, Robert, that it only applies to people that hold crypto as a investment, as opposed to those who hold it as a trader. Are there any criteria or benchmarks for taxpayers to use to work through whether they are a investor or as a crypto trader?
Sure. There are rules and I can distribute them. So the security trader is a specific definition under the Internal Revenue Code, and I apply the same rules to whether they're a crypto trader or not. Nick, do you do the same? Do you apply the rules in the same manner if you're a trader?
Are you talking about section 475?
Yeah, 475.
Yeah, I mean, I think we still need probably official guidance as to if 475 applies to cryptocurrency or not. But yeah, I think generally speaking, there are taxpayers that take the position that if they're in, basically the business of trading crypto assets, then they could take that position that they mark to market the assets.
Right. So Sean, to answer your answer specifically. All right, there are rules within the Internal Revenue Code. It's generally 475, and it's how you treat the income from trading versus investing. In the law, the very short version of this for this purpose is an investor holds something for long-term appreciation, dividends, and interest. A trader owns something to turn the asset over and make a profit in the trading of it. Happy to have a longer discussion about that and lead people to where to find the guidance of it. It's a facts and circumstances test. It's not a bright shining line. Some people think they're traders when they're really investors because they don't meet it. But and in this case, that's a great question, because you got to be careful, because it also affects in how you're measuring your basis.
Yep. Yeah, go ahead.
Yeah, so okay, so I'll jump in on a couple of items here. Yeah, so I think the one that I would call out. So we got really deep into the guidance very quickly here. Very deep, very quickly. What I'll do is just stepping back really at a high level. The way that this has been implemented, basically, I'd say 90% of the folks that we work with, and probably that are in the room doing things like, managing digital assets, paying taxes, all that kind of stuff, have traditionally been using a universal inventory for their wallets. So what that means is that, like, if you have two wallets, you have wallet 1 and wallet 2, and a Bitcoin comes into wallet 1, and a Bitcoin comes into wallet 2, then you spend out of wallet 2, but you're using FIFO. What's going to happen is that you're going to relieve the lot out of wallet 1. what is essentially changed with this Rev Proc was that the IRS said that that kind of universal inventory is not allowed. That is not in line with now. I'm not a lawyer, so there's probably a more precise way to say it, but they basically said that you have to be using a wallet by wallet inventory rather than a single universal inventory. So the thing that Nick and Robert talked about briefly, which is the reallocation piece, the reason that's important is because if you've been using a universal inventory, there is literally zero chance. I mean, there's like I don't know, 1 in a billion chance, like your computer screen falling through your desk because of molecular alignment, like chance that that what you have in your wallets lines up exactly with the lots that you still have left over in your actual lot inventory. And so the reallocation is basically a process to say, okay, you have a set of lots that hopefully add up to the balance you have in your wallets across all the different accounts you have. What you need to do is you need to take those lots, and because we realize that there's a problem here with how those with how you've been relieving in the past, and you're going to take those lots, you need to reallocate them to the different inventories that you have across the wallets, and you're getting a one-time pass, a one-time safe harbor to do this. But to what everyone just said, we have a month and 12 days to finish doing that, because it really has happened before the first crypto transaction of the year. This is where you get a little bit dicey, because if you're earning yield in ETH, the first crypto transaction of the year will be at 12:01 in the morning. Now that's not a sale, that's an acquisition, but still there's a lot of like interesting questions to be had about when exactly you have to have this done. But to be very, very conservative, you probably want to have your reallocation done by the end of the year, realistically speaking, if you're all active with crypto. And there's a big project here to basically say, okay, here are all the lots I have. Here are all the wallets I have with balances. I need to take all these lots and place them into these different wallet balances. And I have 42 days to kind of do that at this point. So I'm just let's bring it real back to like exactly what's going on here is there's a shift from like universal inventory to like wallet level inventory. And that's not something a lot of folks have been doing.
Yeah. And one thing another thing that we run into, that Nick and I run into in our practices, is sometimes people don't even know what method they're using to determine basis. It could be hypo, highest in, first out. It could be universal. It could be specific allocation. That's another, I guess, that's the crawl before you walk. What you need to do before you actually implement 2428 is figure out what method you're using. Especially if you're using software for this, is figure out what your software provider has been using to measure your basis, so you can at least having a good place to start from.
And in terms of the conversations from the side of the brokers, right? What are they talking about here? Because it kind of strikes me that, to echo Robert's point earlier, that the onus is on the individual taxpayer as opposed to the brokers. And from the point of view of those brokers, Jesselyn, what are those ongoing conversations? Because even though the onus is on the taxpayer, I have to imagine that there are going to be questions asked also.
Yeah, I want to start off with, it was a really good segue, Pat, your example that you used. I'm a very visual person, and using that example makes it super accessible for other people that are like, huh? Like, what is it? But your example started with 2 wallets, and you were sort of silent as to, was it a wallet at an exchange? Was it a wallet at a
which is where all the fun
self-hosted?
comes from.
Yeah. So let's take your example to the next level, and that'll sort of branch into some thoughts from the broker perspective. Imagine there's this one Bitcoin I'm going to use Coinbase. Everyone knows the name. 1 Bitcoin at Coinbase and 1 Bitcoin in a self-hosted wallet. If the asset was actually sold, let's say from the self-hosted wallet, but the taxpayer treated the basis as having been sold from the Coinbase unit, that would have been a universal approach. And so fixing this is important so that there's no double dipping of cost basis later. And so where could that actually shake out and impact the taxpayer? So in this example, the actual quantity of assets that remain is 1 Bitcoin, and it's physically sitting at Coinbase. But the quantity of cost basis that remains is 1 in the self-hosted wallet. And so what the Rev Proc is trying to do is say, take that phantom basis that's over here in a wallet where there's no actual assets left and put it over here at Coinbase. And now the reality of 1 and 1 match each other. So that's what it's trying to do. So now let's look through to the future. I'm going to go forward into 2026 for a moment. Starting in 2026, the brokers like Coinbase will start tracking, calculating, and relieving cost basis lots and reporting that on 1099 DA. Up until that point, they'll just be reporting gross proceeds from the sale, but the basis will be blank. Now that only applies for acquisitions from 1/1/2026. These assets we're talking about here that need to be put somewhere, need to be allocated. The brokers are never going to report the value of cost basis of those assets if they're sold on their exchange. So you might ask, well, then why does the broker actually care about this Rev Proc? Yes, because the broker needs to know which assets are being sold. So in my new example, let's say that at Coinbase, a taxpayer has 1 Bitcoin that they bought yesterday, and then they buy a Bitcoin in 2026. So now they've got a pre-2026 and a post-2026 Bitcoin. And they have different values. One might be higher than the other. If the taxpayer has made an election to have a spec ID HIFO, for example, the broker needs to know the value of the assets, both the pre and the post asset, in order to properly choose which asset is the one that's been sold. But if it's the pre-2026 asset that's chosen to be sold, the value of the basis is still not reported by the broker. Now, to bring this example in for landing, where could this get screwed up? Well, if this allocation hasn't been done, or it wasn't communicated to the broker, or the broker did not accept the communication, then the broker might say, oh, this 2026 Bitcoin is the highest value. You told me HIFO, that one's got the highest value. Sold, 1099 DA comes out, it's got proceeds and cost basis on it. And maybe it looks like this huge gain or something. But actually, it should have been the other one that if that had been the chosen one, the pre-2026, the broker would report proceeds and no basis. So summarizing that, the broker doesn't care about the value of these assets because they will always report them as blank basis. But they do need to know what elections that the taxpayer has made and how they've allocated all this basis in order to choose the right assets when they're following HIFO, FIFO, LIFO instructions.
And I'll add one thing that's a corollary to that, which so Sean and Robert already spoke a little bit about this, but it's worth mentioning again. The Rev Proc that came out was specifically focused on capital assets. So that was, assets you're holding for capital purposes. It definitively excluded ordinary assets. Now, the reason I mention this is that I don't think many of our clients have spent a lot of time doing that analysis of either what's capital versus ordinary or what's not. And the proof point I can use for that is that something like impairment, which is used by most of our enterprise clients, does not actually apply to capital assets. Does not actually apply to ordinary assets. Applies only to capital assets. And so most of the folks we know that are using impairment and now fair value are probably applying that to capital assets. So there's probably a pretty good chance that you and your clients and your companies that you work with are treating all of your digital assets under capital treatments, when in fact probably a lot of them, especially ones where you're receiving crypto as revenue, probably do fall more under ordinary. And that it creates yet another bifurcation here, which is it's very, very unclear today what the rules are for ordinary assets. The Rev Proc that came out only applied to capital assets. They did not release guidance on ordinary assets because I think they don't think people have ordinary crypto assets because, I don't think the IRS realizes that people get revenue in crypto and stuff like this crazy new world that we all live in every single day. And so there's a lot to be done there to figure out, like, there's projects for everybody to do in the next, like, again, 42 days, which are all around, like, determining what's capital assets versus ordinary assets, understanding where the new rep procs have fit to you, doing any reallocation you need to. And then potentially, one of the things that, like, Bitwaves is rolling out is the ability to actually segregate inventories between capital and ordinary assets, because they technically are totally separate inventories. So we talked about inventories going from a universal inventory down to wallet level inventory, but in fact, you have one level deeper than that, which is you also should be segregating capital versus ordinary assets on that inventory. So there's a lot to be done here. There's a lot of projects to be done here over the next month and a half or whatever.
Yeah. Pat, the one that, as you were talking, the one that kind of like put the knot in my stomach was when I'm doing a tax provision this year. And what am I doing about assets that may or may not exist any longer? And what do I do about my different and cost basis and value of the assets? Yikes. I'm not looking forward to doing tax provisions this year, buddy. Oy. This is another twist that people aren't thinking about, especially people that have to issue audited or reviewed financial statements. Oh boy.
Yeah.
I will also add one like timeline notation. There's been a lot of work, AICPA task force, et cetera, on informing the IRS that there's a lot of help that's needed in this area. Coinbase actually put out a letter, it's published on their website, also advocating for a delay in this Rev Proc, also to align with the broker regs and the 1/1/26 timeline for cost basis reporting, because kind of back to your earlier question to me, one of the conversations that I have with a lot of brokers is their ability to actually accept these instructions, even if so accepting the instructions is optional to them. I think, Robert, you pointed that out earlier. That is correct. It is optional. So brokers, in implementing the 1099 DA regulations, have a whole long list of stuff and a limited budget. They're going to be going after stuff they're required to do, and optional stuff is just going to go to the bottom of the list. But additionally, so firstly, it's optional. And second, there's not been enough time for the brokers to actually design the interfaces and the systems for them to take in this information. So even the best intentioned brokers that would like to optionally provide the service of accepting these instructions from taxpayers, they can't. And so Coinbase is advocating to the IRS as well, like, we need some more time to think through this.
Hey, Sean,
Yes, Rob,
real quick, is there some way that we can post the AICPA, the link to the AICPA comment letter in the Q&As?
I would assume that would be the host, which is Ron. I believe.
All right. Well, when the host comes back, I'll ask him, because I think that'd be a good thing, because people could access it right now without having to go searching for it.
We'll take care of it.
Yeah.
We'll take care of it, Robert.
Thank you, sir.
Thanks, Ron. And sorry, those are my dogs barking upstairs. But Jesselyn, to your point, I was going to ask you. You had mentioned that investors have to communicate these choices, the bases, and I guess going back to Pat's point, how they're doing their allocation to the brokers. How does that process actually work? Even if the interfaces aren't totally up and running yet, how is that process going to work, ideally?
We don't really know. It is largely so firstly, you already pointed out there's a software play, there's an interface play. And so Legible is looking at how we can facilitate that and help brokers with software needs. But there's also the regulatory requirements within the regs themselves and what they say is or is not acceptable information that a broker can take from the taxpayer. Now, one thing that's interesting, and I'm still diving into this with some of my peers and talking to the IRS about this, when the regs talk about customer provided information that the broker can take this stuff and verify it, it seems to only refer to transferred in assets, which leaves open, well, can a broker accept instructions and information about assets that were not transferred in, that were purchased within the four walls of Coinbase, but for which the taxpayer needs to effectively reconcile their records? That's not entirely clear. The regs further talk about, well, what's the broker's responsibility with regards to the accuracy of the information? They need to verify that it's reasonable. And the IRS kind of gives some examples of what's reasonable, like immutable blockchain data and trade confirms. We're like, that's kind of not realistic. I mean, even Coinbase doesn't give like a Schwab trade confirm. So the industry is working with IRS to help them better understand what do we think is a reasonableness check by the broker, if one is even necessary. Because again, the broker only needs to be able to accept this information for purposes of choosing the asset to dispose of. It does not change the value that actually gets reported on the form.
A lot of nuances there, obviously.
I
Go ahead.
Yeah, I may jump in here and speak to the Coinbase letter comment here real quick. So have had some informal discussions with the IRS, and obviously none of this is on the record or in writing, but I would not anticipate there being a delay in this revenue procedure. I think taxpayers should prepare now and act as if the due date is going to be, generally speaking, the end of the calendar year. And I also think it's important that we talk about what are some actionable items that taxpayers can do to maybe work through this, maybe reduce their administrative burden.
Nick, by the way, I was hoping you would get to that because you made a fantastic post on LinkedIn a couple weeks ago that was like, hey, you want to reduce your burden of this RevProc? Here's some clever things you can do. I hope that's what you're about to go through. If not, we should share the link to that too.
Yeah, absolutely. That's exactly where I was going with this. And some of this is maybe not practical in all cases. So, the goal of these is just trying to throw out some ideas. We were brainstorming on like, okay, this revenue procedure is a thing now. How can we go about trying to reduce the administrative burden? So one of the first things that we kind of brainstormed was, if you have a bunch of wallets or if you have a bunch of exchanges open, try to consolidate those as much as possible. So let's say you have 10 wallets, right? If you can, if possible, consolidate that to one wallet at 12/31, and then you can do a global allocation that says, I'm going to allocate all of my cost basis to this one wallet. And boom, you're effectively done just by doing those two easy steps. I say easy, maybe easier than going through and trying to do a specific allocation for all 10 of those wallets, right? So that's one option. Another option is, and again, practicality matters here too. Could you just liquidate all of your assets at 12/31 or before 12/31? And then if you want to get back in, you can get back in on 1/1/2025 or after, because then you don't have any unused cost basis, so you don't have an allocation to even do it all. And as of 1/1/2025, you have to adhere to this new wallet by wallet method anyway. So that's another option. So there's a couple things out there that taxpayers can do. I mean, obviously you can go through and work through the specific allocation or global allocation as well. And then, as with Pat joining the webinar here today too, leaning on some of these crypto accounting softwares like Bitwave is another way to try and reduce your burden as well.
Yeah, and I was gonna say thanks for the call, Nick. I appreciate it, brother. I was gonna say. So there's what Nick just said, which is incredibly valuable, which is how do you reduce your administrative burden. There is the other side, which I guess I won't call it how do you increase your administrative burden. I would say how do you properly take advantage of this opportunity, because it actually genuinely is a really, really, really great opportunity for folks that have a wide variety of cost basis assets. You can do some really clever stuff. So some of the stuff that we've seen, and I'll give credit to Deloitte for this, but Rob Massey had the idea to basically say, if you have assets that you're sitting on that are in ETH2 staking, so you've staked your ETH, you're doing your proof of stake assets for ETH. One thing that would make a lot of sense is take all of your low cost basis assets and put them into these staking wallets. So anywhere that you do not have immediate access to those, to the funds, and it would be difficult for you to spend them, put your low cost basis assets there. Put your high cost basis assets into your hot wallets, and then your cold wallets can have something in between those two things. So in fact, like if there's a great project here for folks to do that are in the consultative space. So there's like reducing your burden, which is good for taxpayers. but there's actually optimizing your tax position, your cost basis position. That is a real look at your wallets, how you are using them, your cost basis that you're sitting on, and then making really strategic allocation of those assets so that going forward, you actually can really benefit your business by having this one-time get out of jail free card, which is super, super exciting.
And another thing that might come out of that analysis, surprisingly, is you might have some crypto assets with built-in losses that you might want to realize because you've had some profits this year. And the nice thing about crypto, it's not subject to the wash sale rules. So you could sell that on December 31st, realize the loss for tax year 2024, and repurchase the same asset again on January 1st, 2025. No wash sale rules, but you've realized a loss that may have helped offset any gain that you've realized for having to go through this exercise.
By the way, I was shocked that the Rev Procs did not include the wash sale rules. I guess this is probably because I'm not a lawyer and there must be some reason.
It has to be done through congressional action.
Yeah, so. It was a Congress thing, but it is crazy to me that loophole is still out there, which is awesome.
But one small clarification though.
Okay,
there are digital assets that are subject to wash sale rules. So if a digital asset represents a traditional financial product that is subject to wash sale rules, like a mutual fund, like a tokenized equity, tokenized mutual fund, those are subject to wash sale rules, and they continue to be subject to wash sale rules.
Yes, that's correct. So if you're invested like in BlackRock's Ethereum ETF, the rule does not apply to you. This is just coins that you hold, digital assets you hold directly.
And there is the economic substance rules as well, that you can't just perform a transaction just specifically for tax purposes as well. So you have to be wary of those as well.
That is an interesting question though. If the sole reason someone was doing this was for tax administration purposes, but not for tax purposes, I find that an arguably reasonable position. Like, I did this to clean up my record keeping, not in order to, manipulate tax losses and tax gains. That was just a byproduct.
Right. The Supreme Court years ago has said a taxpayer has the right to arrange their affairs to pay the least amount of tax possible. So for tax administration purposes, you betcha. I mean, you can argue that all day long. And I think you have an arguable position. But I'm sorry, I'm not giving tax advice. So,
so to try to piggyback on that stuff, Robert and Nick, how is this Rev Proc timeline and implications of it? How is that sort of, or rather, if you were talking to a taxpayer, and there are some other sort of changes coming to the tax code, 1099 DA, there were other changes, broker rules and all that. If you had to prioritize which of these upcoming tax changes, be it on the taxpayer side or on the broker side, should be ranked 1, 2, and 3 in terms of client's priority, which, how does this Rev Proc sort of fall into that ranking?
I would say that everyone's facts and circumstances are different. So definitely consult your advisor. But generally speaking, since the due date for this revenue procedure is coming up so soon, I would definitely think that this would be something that taxpayers would want to be aware of. And I think one thing that taxpayers and their advisors can do that I would recommend is kind of working through a flow chart first to see, does this apply to me? And some of the questions that you can ask are, do I own crypto assets that I've previously sold in prior tax years? Because if you simply just bought and held, then this doesn't apply to you because there's no cost basis that you've relieved in previous years that this really applies to. Another question you can ask is, have I even used the universal method? And you can reach out to some of these crypto accounting softwares that maybe you've used in the past to determine if they're using the universal method or wallet by wallet method, or it may be very clear if you log into your account, you may be able to see right away if you've done that. So, one, do I have cost basis that I've relieved in previous years? 2, have I used the universal method? If the answer to both of those is yes, then this probably does apply to you. And then I would encourage you to go ahead and start trying to work through how you can, meet the safe harbor.
There's also one other, and it's obvious to those of us on the call, but again, accessible to anybody watching this. if you're a CPA or tax advisor and you're kind of new to crypto and you take this back and go look at your client situation, if they've only ever bought, held, and sold crypto on a single exchange, this also doesn't apply to them. It's really the concept that they had, that they held digital assets either in multiple exchanges or or multiple self-hosted wallets. But if it's a single exchange, which is actually a lot of taxpayers, they also don't need to do anything. You know, kind of think back, I think some of this has changed, but early on, like with Robinhood, you could only, if you were holding it at Robinhood or maybe it was Revolut, you could only buy and sell it there. You couldn't transfer it out. So there are a lot of taxpayers out there that aren't impacted by this because they've only ever used a single exchange.
Yeah, good clarification.
I'll
Yeah.
throw out another interesting complicating factor, because that's been my favorite part of this is so to Jesslyn's point, perfect example. There's one caveat to that, which is not exchanges but custodians, where I think there's a lot of ambiguity. So the way that the Rev Proc was written, and look at this, the lawyers can opine on this after I finish my little piece. The Rev Proc was written with a when they defined what a wallet is in the Rev Proc, they basically tied a wallet to a private key, which was really a strange thing to do for the IRS, because like 14 years into this, like we know pretty much people don't even deal with their private keys that much anymore. I mean, it's one of those things, like it's been abstracted away. If you have a ledger, you have a ledger, you might have 100 different wallets on that ledger that essentially are all derived from the exact same private key. So is that them saying that, you know, one single private key lines up with any wallet on a ledger? The same question goes for custodians, which says that, you know, an account on a custodian, where someone like Coinbase Prime is a good example, where you might have 10 different vaults. Well, you have absolutely zero visibility into the private keys behind those vaults. You have zero visibility into like the structure behind those vaults. It could be all one single private key that they just do a virtual account on top of. It could be omnibuses. You have absolutely no idea. And so it's one of those things that there's ambiguity embedded in the guidance here, even in whatever was 450 pages of guidance. There's still ambiguity about what exactly a wallet is. And so I think it's very clear. Justin's point is great, which is like, if you have an exchange, you just trade an exchange, that's no big deal. It then gets a little bit more complicated if you're on Binance, where you have an exchange account that then could have sub accounts. I think that's one click less clear if those are treatable, if those are one universal inventory or if those are multiple inventories. It then gets more unclear if you're on Coinbase Prime, where you can have separate segregated vaults and then a trading wallet that you move into, what inventories you might have there. And then it gets even more unclear that if you are moving assets off of an exchange, and you have like a ledger, well, is that ledger one inventory because it's one single private key? Or should each of your addresses be on that ledger be a separate account or separate wallet for inventory purposes? Which then gets even more complicated when you get into like something like Bitcoin, where a Bitcoin wallet might use an XPub, which you might have 1,000 addresses, or each of those separate. So this isn't meant to be like a never-ending rat hole, which crypto accounting and tax obviously is. But it's meant to sort of point out that there's actually still places where doing an analysis can help you. So if you do an analysis and you decide that treating your ledger as a single inventory is more tax advantageous than segregating each of the individual accounts on there based off of the wallet address, that, there are probably arguments to be made by smart people who can write a memo who will say, yeah, the way we read the Rev Proc is that it's based on a private key based on the ledger. So one of the things that we did at Bitwave is we've actually had this notion of like inventory groups, where you can take 10 wallets and group them into a single inventory and use that, or you can break them into wallet level or any sort of combination there, because we really think that there's going to be a lot of opportunities for advantageous treatments, for cost basis treatments, based off of the ambiguity, like the little tiny ambiguity that's left in the guidance there.
I'm going to add one more just to bounce it back on myself to sort of step back again. Accessible CPA tax advisor that might be watching this who's really new to crypto. I love how you went into that nuance, because it gives people that takeaway of like, oh, I really need to look into this. There's another example, just again, we all know this, but new people to the industry might not be aware. If you're talking to a taxpayer and they say, oh, I've got a Coinbase wallet. Well, there's the Coinbase exchange, which is a broker and is going to have some 1099 reporting, but Coinbase also has a self-hosted wallet that taxpayers can be using. And so those are definitely two different things. So when you're talking to the taxpayer and they just say, oh yeah, my assets are on Coinbase, you have to ask more probing questions to better understand from your taxpayer, what is the product they're using? I kind of I started thinking about Coinbase like I think about PayPal. Everyone thinks, oh, if you use PayPal, you get a 1099K. That is not true, because there's some products of PayPal that are obligated to issue 1099Ks because they're TPSOs, that term for 1099Ks. And there's some products of PayPal where they are simply a software that transmits instructions and they do not issue 1099Ks. So CPAs, tax advisors that are new to this, you really have to understand a bit more of the products, especially when you're talking about these bigger players like a Coinbase, where the different products have different outcomes.
Yeah, so I think the takeaway from this segment is, as practitioners, and this is what I'm going to do, is I'm going to take a step back first, and I'm going to figure out, what my client holds and how they hold them, and what are they? Are they an investor or a trader with respect to them? And then go through an analysis to see how I should group things to get the best tax answer. Regretfully, it's the 18th of November, and and I think Pat was the one that said, we got 33 to 43 days, something like that, to figure this out. That's that's going to be a pretty heavy lift.
Yeah, this is like there's a great project to be done here, but we have a month and a half minus Thanksgiving minus Christmas. Like that there's not a lot of time to do this, but there's a ton of work to be done.
So
And I think for folks that are like more on the consulting side, folks on the consulting side, I think these are great projects. I think these are like, 10K little projects to go and do with your clients that can actually be incredibly impactful on their taxes for 2025.
Right. So in contract world, in tax world, a lot of times we write agreements that are effective certain dates, but are written 60 days, 90 days subsequently. Nick, do you think we can get away with doing something like that?
Yeah, so there are some nuances to how this revenue procedure is written. So like the global allocation, for example, all you have to do is document what that global allocation is going to be in your books and records by 12/31, and you have until the later of your first transaction after 1/1/2025, or when you file your tax return that includes the 2025 tax year. So you could, generally speaking, have almost up to a year and a half from 12/31/2024 to actually go in and do the arithmetic. Some similar nuances for the specific allocation, although that one is flipped. It's the earlier of your first transaction on 1/1/2025 or the tax return that includes 1/1/25. So theoretically, if you choose to do that specific allocation method and you do something as simple as send Bitcoin from one wallet to the other wallet and incur gas fees to do that, you have just triggered your due date requirement by performing that transaction. Now, how is the IRS?
Nick, do you read it as an acquisition also? If you have assets staked in ETH and you get 12 seconds after midnight you get some ETH deposited, would that also trigger it? Is it either direction?
Yeah, I mean, I think that could be considered it as well, although it's very unclear how it's written. But I think if you're being conservative, right, like you have to treat that as an acquisition as well. Then you get into the whole thing of dominion and control and things like that, which we won't go down the rabbit hole of today. But I think what I'm trying to say here is that there's nuances to how this can be done. You can delay it, but how is IRS going to police this? I don't think anyone knows. For example, if you get audited by the IRS and they pull in that 2024 tax year that they want to audit, and you say, oh yeah, I complied with the safe harbor, and here's my allocation, here's how I did it. I don't know how they're going to be able to say, okay, well, prove to me that you did this before 1/1 of 2025 or before your first transaction in 2025. I think generally speaking, there's probably some leeway there, although it's up to each taxpayer and their risk appetite.
Nick, remind me, is it correct to say that any taxpayers that are currently under exam are not eligible to use this Rev Proc and Safe Harbor?
Yeah, I think that's correct. I'd have to go back and double check, but I think that's right.
Because it's interesting to think if they were under exam for, let's say, I don't know, 2018, are they completely barred from using the Rev Proc? And do they then have to basically go amend any open tax return year to transition from universal to wallet by wallet?
Potentially. So, again, depending on what your risk appetite is, let's take the other scenario. Let's say that you just missed the due date and you don't comply with the safe harbor. What are the consequences? There's not really any, consequences immediately. You're kind of playing the roulette of IRS audit, and if you will get audited by the IRS, right? If you never get audited by the IRS, then it may not be an issue, but you're running that risk of having those tax years that are still open being audited, and the IRS going back and recalculating your cost basis in those years.
So Nick, I'm going to get really technical. So do you think that there's 9100-2 or 3 relief if I miss this due date? For those who don't know what that is, I'm sorry, I'm going to explain that. So there are certain circumstances. Okay, there are certain circumstances under an Internal Revenue Code, Treasury Regulation section. It's Administrative Section 301-9100-2 or 3 that give you an extended due date to make missed elections if you meet certain requirements. So I did, until you mentioned that, Nick, I hadn't thought about that before. I wonder if there would be 9100 relief for any of this.
Off the top of my head, I can't give you an answer. I want to say that this, but I want to say this is not an election. This is a safe harbor, and so then it may not apply.
It might not. Well, it reads there is. I think the word you have to elect this method, and I believe you elect the safe harbor method. So I have to go back and read it. So now I've caused myself some additional reading.
Oh, also one question that I had during our conversation during this last bit here was, for a taxpayer, what is the criteria for acceptable documentation for their allocation choices?
It's also unclear.
It's also unclear. Okay.
Yeah.
Wonderful.
The IRS basically says, have this documented in your books and records, but they don't say exactly what that means. And going back to that informal conversation that I've had with the IRS, some of the others that I think that are listening were also on that call. They basically said that if you make a good faith effort, then we can generally rely on that documentation if you make a good faith effort. And so that can also include relying on like an inventory report out of Bitwave as an example, or some of these other crypto accounting softwares that offer that inventory report that you can run as of 12/31/2024. Even going through and doing your own reconciliation in an Excel spreadsheet could also suffice as well.
Yeah, and I'll say the way we're kind of approaching this is that, so what we're doing is we have a report you can download that's your inventory report. We have a spreadsheet template that you can then do the reallocation if you need to. If you're going to do this specific allocation like we've been talking about, we have a template that you can then basically drag your lots or select what wallet you want to put your lots into, run a macro to make sure all the numbers add up, things like that, and then re-upload that so that the way our inventories work are a little bit different than everyone else's, because we actually let you have segregated inventories from the underlying assets. You can have like 100 different things we call inventory views that are all different views. So you can basically upload your reallocation to a new inventory view and then suddenly get basically have this sort of like clean overview of like historic gain loss calculations, reallocation, and then the new treatment going forward on the wallet level. So there's a lot. I mean, this is one of those things that we've been working on since July or whenever these procs came out, that there's a lot of complexity here. It is not easy. It's not something just to sort of take for granted that it'll work out of the box. I think a lot of the less enterprisey sort of tax tools that are out there, like especially like more of the consumer ones, I think are going to have some trouble with this. I assume you'd have to create new accounts to like reallocate through an upload method, something like that.
Patrick, maybe that's a moment to point out, there was a question in the chat that I noticed. Someone's mentioning that there's a lot of retail crypto software platforms that have not upgraded from single universal inventory to wallet by wallet tracking. So this person is asking, like, what percentage of software has done this? Maybe it sounds like Bitwave has done that, but I think my question, so I think we answered the question from this person without knowing exactly. Maybe you do know how much software has has done this.
I
But, like,
think almost none have done this. I think like very few of the retail crypto tax softwares. So that'd be the you know, coin trackers and ledgers, those kind of
right,
guys.
for
I
the
think
individual
very
taxpayer.
few. Yeah, I think very few of them have done this. They all were doing a universal inventory. It's a really nasty change. The way a lot of software is built, it's a very nasty change to go back and do this. So I don't think
It's a one-time event. Like, if you
it's a
think
one-time
about the
event.
perspective of the software providers, they're not
Yeah.
getting an additional value or revenue from doing this. And
Yep.
so I'm not saying that they're not doing it, but this
Yep.
is hard stuff, and you
With
kind of
very
have
little
to
return on
order
investment.
very little return on investment.
Yeah, 100%. So this is one of those things. I mean, that's, you got to go do this like right now. Like if you're concerned about this, like go look right now. There's a very good chance you're going to have to do a export re-import of like your assets into a new account if you actually want to do this reallocation. And then you might even have to move providers if they don't support wall level inventory, because a lot of them are based out of other jurisdictions, like the crypto tax calculators, the Australian, you know, company. They might not even really have eyes on this piece of it.
And there's a number of software calculators out there that are still active, like people can still use them, but they're just in maintenance mode.
Yep.
They're not adding new product features.
Yep.
Excellent conversation, excellent points. And to wrap up our time here today, I'm going to go around the panel and ask, and we've also touched on this during our conversation, but if you had one 30-second piece of advice, you know, for any taxpayers or CPAs watching this today and then having heartburn, what is that one sort of 30-second piece of advice? And then two, where can people find more of your thought leadership? So I'll go Robert, Jesselyn, Nick, and then
Generally, I mean, mine comes through the AICPA Digital Asset Task Force, or it comes. I'm not a big writer and publisher. I'm more of a one-to-one type person. Mine comes in conversations. I mean, so if you want to have a conversation about this and strategize, you know, please give me a ring. Happy to talk to you about it. Happy to talk you to talk you through some of this. Happy to work through with it. But you know, most of my stuff is done in collaboration with Nick through the Digital Asset Task Force and with the Wall Street Blockchain Alliance.
My thing that I would ask people to walk away with is have some grace for the centralized exchanges, the brokers that need to issue these 1099s. They are in a very unique situation where traditional financial institutions had many decades to implement 1099 reporting in phased sort of chunks. And these digital asset brokers are having to slam a whole operating model together in a really compressed time frame. So if you're not getting 1099s or you're not getting correct 1099s, don't expect a lot from the brokers. You really are going to need to be prepared to manually fix things, reconcile, track your own basis. And you can find me and our thought leadership at the Legible website, and I post a lot on LinkedIn.
Yeah, this is one. I'm going to add one thing that Jesselyn just said. Is, you know, here the IRS or the Treasury is trying to take something from a centralized way of doing things like stockbroker rules to a decentralized way of doing business, and there's a huge disconnect. It's not going to work right at first, so give it time and be patient.
I would say for taxpayers listening, don't underestimate the amount of time that this is going to take in order to comply with it. So start thinking about this now. And if you are in the bucket that maybe this doesn't apply until you file your tax return, don't wait until April 14th if your tax return is due on April 15th. For the advisors that are listening, I would say kind of something similar. But I would start with just first making your clients aware of this situation. And maybe the first thing that you can do is run a report to see how many of your clients check the digital asset boxes yes in previous tax years. And that may be a good starting point as to who to reach out to and who to make aware of this.
Yeah, Nick stole mine. I was just gonna say, get on this. This is like, we have literally no time to do any of this kind of stuff. And it is tons of work. It's hard work if you're gonna do it right. But it can also be very advantageous for your organization. So do not wait at all on this from that side. You can find me at bitwave.io, at Pat White on Twitter, at Pat White on Blue Sky, and then LinkedIn. I'm on there too. So yeah, it's fun. Thank you guys.
Excellent.
Thank you.
Excellent conversation, guys. Thank you all so much.
You're welcome, Sean.
Thank you, everyone, on behalf of the Wall Street Blockchain Alliance. Thank you for everyone who attended, and to our panelists, the amazing thought leaders. Thank you again. This recording will be available on the WSBA YouTube channel in the next few days, and we will leave it there. Have a great rest of the day, everyone.
Thanks, Ron.
Bye-bye.